Now the focus turns to the quarter we're in right now, the first quarter of 2019. And there all bets are off, where some are actually saying, forgetting a gain, we could look at a slight contraction. It will be the first in a long time to Stanford School of Business lecturer Dave Dodson. Very good to have you back, Professor. How's this looking?
I don't think it's looking that great, actually. When I looked at the beat rate, or the percentage of companies that beat their earnings estimates in the fourth quarter, it wasn't that great. It was 71%. Now you go, well, that sounds pretty good. It's actually not that good. Remember, corporations issue padded numbers, which they plan on beating.
Yeah.
So traditionally in the last year, it's been about 80% of the companies. This last quarter, it was 70%. Which means that 30% of American companies didn't beat their own padded numbers in the fourth quarter.
That's very well put. That's very well put. The other thing we were missing, too, not to downplay this, is what's happened on the revenue front, because the miss there has been a little bit more noteworthy, right?
Yes, that's right. So they look at the beat rate both in terms of the earnings and revenue. The other way to think about this is this. The earnings estimates are what the company signals to analysts on what they think they're going to do. But I think maybe a better metric is to look at how they compared to last year. And in the fourth quarter, it wasn't really that bad. It was just not quite as good as they thought. What's interesting is the clear signaling that corporations and CEOs are giving for the first quarter of 2019 and 2019 in general, which is things are slowing down, and they've been crystal clear about that, as you just pointed out. And I think why that's so important is the economy is fragile, and it's fragile because of one word, which is debt. Consumer debt is an all-time high, and corporate debt is an all-time high. And just take consumer debt, for example. This economy has not been fueled by productivity gains. It's been fueled by people borrowing money to buy stuff. That's why you can have stagnant wages and still have growth year after year. And so what happens when you have a lot of debt is when your spouse comes back and says, I lost my job, or you crash your car, you're less able to react to it. And so the contraction is far greater than that. And that's, I think, what we have to worry about. Where the economy's got a little bit of a hair trigger on with all this debt.
You know, also there's the issue of how a much more aggressive, in-your-face House run by Democrats is going to get at companies. Of course, the Democrats taking over, no fan of the tax cuts, on saying they're a little angry that a lot of companies use that, as they're free to do, to buy back their stock or hike their dividends. And some of them want to end that. And they're going to make life very difficult for corporate chieftains who argue for that. Now, it's only the House. We still have Republicans running the Senate. We still have a Republican in the White House. But this could get a little feisty, right?
Well, it's going to be kind of interesting when Senate Democrats and congressional Democrats try to tell CEOs how they're supposed to use their money. Look, it's their right to borrow money, and it's their right to spend it legally and however they want. And it's made sense in the past to use that money for corporate buybacks, right, to pay dividends and M&A. But that doesn't do anything for productivity gains. So the curious thing is this. I think the Democrats are right that this cheap money, which has been fueled by Fed keeping the interest rate so low, has not been used for our long-term economic health. It's been used for short-term earnings. I think they're right there. What they're wrong about is that Washington, D.C. can start telling corporations how they should or shouldn't use their cash flow.
That's where it gets tricky. Yeah, that's a dangerous area. I mean, them giving financial advice is a little risky. But we'll see. Professor, thank you very much. Good seeing you. Dave Dodson, Stanford School of Business lecturer.